Hello and good afternoon. I welcome you to today's Trading Spotlight webinar here on Friday. It's the 5th of June, 2020, and I'll be the moderator here of the upcoming 45 minutes around. We want to focus on a very, very interesting trading strategy, one which to some to some extent is very, very similar to the one we already discussed several weeks, months ago. I'm not sure, but I remember that we had a webinar on gold and how to profitably trade gold with one trade a week, in fact. And so we want to adapt the strategy today. Adapt, yeah. Well, to silver, and have a look here at silver, and that's especially interesting today. So it's a great time to be alive, to be honest. Just to give you a quick update, I think many of you who are right here, right now, probably have seen the U.S. employment numbers, non-farm payrolls, which came in ridiculously high at 2.5 million plus, nevertheless. So we expected a print of minus 8 million due to the corona lockdown. We expected an unemployment rate to push as high as 20%, to the highest level since the Great Depression in the 1920s, 1930s. Yeah, and instead we now saw a push significantly higher, which is weighing, in fact, on the precious metal. So the trade or the idea behind the setup here I present to you today does not play out that well, at least not for now, because the question remains, where does these numbers come from? How does the BLS, the Bureau of Labor Statistics, calculate these numbers? Is this really sustainable? We get to see there. But that's not the topic of today. Nevertheless, I already can assure you that you will be pretty interested in seeing the setup playing out today and how it plays out, and it doesn't so far, at least. So what is today's agenda? So today we want to have, first of all, have a look at the characteristics of silver, in fact, and then we want to show right straight away how the setup looks in the real world. Answer the question, certainly, is the setup really profitable? What I can say is that the setup took a serious hit over the last months, in fact, due to the massive sell-off we've seen also in precious metals due to these liquidations which took place over the corona lockdown over the month of March. And in this context, it's in fact great that we have that because we can then use this as a starting point to show why there is a need for adaptations from a risk and money management perspective, and especially how such an adaptation could look like then, and how to adapt the setup. Before we start, that's me. So my name is Jens Klatt. I'm located in Berlin, in Germany. That's probably the most interesting thing about me. Everything else can be read in an interview I did together with Admiral Markets already last year in June, July, which can be found if you watch this video now on YouTube. You can find this link to the interview in the description box. If not, then let me just see whether I can find it here in the back end, or at my end. But this is not what's most interesting. The most interesting thing probably is the host of this webinar. So the broker, which is standing behind this Trading Spotlight webinar series, it's Admiral Markets, a broker which is for over 19 years now in the FX and CFD industry, has established itself as a world leader, let's say. So it's I think it's fair to say that as one of the biggest brokers here, financial service providers in the FX and CFD industry, with in fact now over 20 offices around the globe. And why is this noteworthy? And that's why it's interesting that I'm located in Berlin, Germany. Berlin here in Germany, the capital of Germany. Admiral has an office too. This is noteworthy because for people who are not that familiar with English, with the English language, and who want to talk to someone in their native language, once they have any kind of questions, which will naturally arise if you're a trader, and whatever question that might be, if it's a technical one, if it's one with in regards to your deposit, if it's a question in regards of do you have an do you have an research piece and analysis for the financial markets, whatever it might be, it's always nice, based on my personal experience, to talk to someone in a native language. English is not a problem, especially not for those right now listening to this, but probably some of you might say, I'd really like to talk to someone in my native language. And that's one of the reasons why Admiral is definitely worth a deeper look, beside everything on top of that, with great trading conditions, very low commissions, very tight spreads, very reliable platform stability. In fact, due to the corona lockdown, we all could see what can happen in the markets. That's a crazy time, and it has never been similar to that, not even during the great financial crisis, 2008, 2009. What I can say is Admiral was there. So the platform was stable, and you had no problem to enter, exit the market. Certainly market conditions, surely market conditions were quite volatile, but still you had a great chance to still trade the markets and to rely on Admiral as your broker, which is a big plus, and something which is definitely worth noting here in this context. And that's why I highly recommend giving admiralmarkets.com, the website, a deeper look. So now let's have a look at today's topic, and have a look here at the characteristics of silver, in fact. Let's have a look here at the characteristic of silver. And one of the reasons why we want to look for a setup which gives us a chance to profitably trade silver. So silver is one of the biggest markets of all precious metals, beside gold. Smaller than gold, yes. That's one of the reasons why silver usually has a higher volatility connected to its name, respectively. Some stronger moves on the upside, on the downside, due to market width, respectively market depth, in this context. But still, it's one of the biggest markets, which is very important. We will see why in a few minutes, in fact. So silver is one of the biggest markets due to its exceptional value storage properties and numerous industrial uses. So or a little more than what we see when it comes to precious metals, or when looking at gold, for example. So there, the industrial uses is not as common as it is when looking at silver. One of the reasons for this industrial use is the conductivity here, which is even higher than gold, in fact, and which makes it here such an interesting market also from the industrial perspective. So what does this mean? It means that the silver market, respectively, one of the characteristics of silver is that it's highly liquid, which is very important. I can already say that right now, in fact. The strategy we want to make a topic here today, in its basic version, works without a stop. And this is very, very important then to trade with a highly liquid asset, in this case. So when it comes to gold, I want to say again, it's the basic version. So just to formulate the idea and take it from there then, and formulate a risk money management plan. But also in the basic version on which our backtest is built, it's very important to know that it's highly liquid. That sometimes the moves are very, very strong in one or the other direction. And we will see this in the backtest, and we will see this in the generated equity curve. But still, it's important to run such backtests and such strategies which work in their basic version without a stop. So with a hard stop loss you place, it's very, very important to run this with highly liquid assets in this case, to avoid that there will be some kind of, or not avoid, but reducing chances of getting to see something like a flash crash, which is completely wiping out the price of silver, respectively of gold in this case, which is very, very what's the word for this? Very unlikely, but still something which needs to be kept in mind, and why it's so important to run such a strategy in the basic version then with a highly liquid asset. And silver also, in addition to that, that's very important, similar to gold, is often viewed as a safe haven for investment, and it's most demanded during times of economic uncertainty. So, which means that the demand here in silver and precious metals in general, especially when it comes to silver, but also gold, is naturally higher once risk aversion among market participants increases. something you probably can see right now when looking at the markets and looking at silver and looking at the employment report we've seen published. So the environment in general. So we look at the developments over the last weeks with all the uncertainties among the corona lockdown, economic uncertainties, a labor market seeing a big hit. In fact, over the last months, or the last 2 months, in fact, now seeing a revival for whatever reason. Again, it's very difficult to say right now whether this is a print which can be interpreted in the way we interpreted it, let's say 3-4 months ago, when markets were, or especially the labor market was, let's call it normal. So it's still something which needs to be answered. But what you can see is that during times of a massive economic downturn, after the initial sell-off happened, that was the liquidation, which happened due to an unwinding of carry trades, but also resulting strong demand for US dollar in this case, which drove also not just equities lower, but also drove precious metals significantly lower. And after this dust had settled, we've seen a massive rebound, and precious metals, especially silver, but also gold, outperforming. And this is exactly what I'm referring to here when I talk about safe haven status, and when it comes to gold, when it comes to silver. It's also common, or not just common, but it's very important to note that silver, but also gold, are highly positively correlated. Negatively correlated to yields, which means if yields are dropping, in this case, especially US yields, if the Fed goes aggressively in regards to monetary stimulus and everything, this is usually something, a monetary policy which drives yields lower. You naturally expect precious metals, which are not paying any yields at all, you expect yields then to drop, while silver, respectively gold, and the demand in those two precious metals on this example should rise, and the price should rise, and vice versa. So right now, for example, when you look at the labor market and then the numbers which were just released, you see a hard and sharp push higher in US yields, which is one of the main drivers for silver prices, respectively gold currently dropping. Yields dropping and the expectation of central banks to step in and to save the markets, let's say, that comes down to then the safe haven status, which results for silver out of this fact, in fact. So now let's have a look here. What is the trade setup? This is a little unfortunate, but so it doesn't matter. In fact, it's very simple. It's very easy. And you will clearly perfectly see why it's also great then or how you can run a backtest yourself. It's not necessarily some probably programming coding skills are needed, but it's not that complicated. In fact, you can also, with some Excel knowledge, run it in Excel, in fact. But I run the backtest. I can already tell you that in Python. In fact, you can also do it in Excel again. So the setup looks very simple. You buy silver every Thursday at 9:59 p.m. London time, so 1 minute before the market closes. In fact, it's not true, because usually it closes 1 hour. I'm sorry, no, it's true. Certainly, yeah. I'm sorry. Now I was a little irritated because German time is 1 hour later. It's 1 minute before the market closes. And then you sell the position on Friday at the same time in the evening, 9:59 p.m., 1 minute before the week closes. In this case, the day closes, but also the week closes, and we are going into the weekend then. And then the basic version, as I already mentioned, here we are working without a stop loss in this case, but we're also working without a take profit. Especially when it comes to the stop loss here, this needs definitely adaptation. So we need to find a way to manage our risk adequately when we trade this setup, or once we plan to trade it in the future then. Because as I said, in the basic version, it works without a stop loss, which is a big problem, especially when times are getting as volatile as they have been over the last yeah, over the last 2 months, in fact. It was 2-3 months, and with lots of volatility, which could cost you some serious headaches, in fact, when you worked with this setup here and no stop loss, in fact. So yeah, and that's it. So nothing more. This is the setup, and everything which needs to be set in this context. I now prepared here a chart which will illustrate you this with an example from, yeah, there, by the way, you can see here this massive drop, in fact, and the high volatility, which can be seen. This is an H4 chart, but if you look at the daily chart, you will clearly see that there were Fridays or Thursday to Fridays when you saw this massive drop in the downside. And if you do not work with a stop loss in this context, then it's creating some sharp volatility in the P&L, in fact. And so yeah, this screenshot now, if I look at it here we have the entry long, which is opened then on the last trading price on a Thursday market close, or 1 minute before that, and we enter the trade at 12.09 USD, in fact, and then we keep the position open for 24 hours, and we close it then here 24 hours later, in this case at 12.61. It's in fact very attractive trade. So we are looking here at a gain of 52 cents and within 24 hours, which is, let me just see, and it's not leveraged in this case, 52 through 12.09. Yeah, that's a gain of over 4%. So it's a massive run. In fact, it's a very, very great example. We will look here, in fact, at the we will look now, before we look at the backtest, we will look at how it performed so far today. We have a Friday today, so the position is open, theoretically at least. So when I show you now the chart, you will see that there's no trade open, but just to keep this in mind, and we will run through this here now in real time if you want. So this is how silver is performing right now. There's the drop lower. Again, let's have a look here at the 50-minute chart. By the way, we can also work with the 50-minute chart in this context, because will there be an update? I hope so. Probably I should have avoided this. Let's go here. An hourly chart doesn't work too. Why? Okay, let's take it that way. No problem. So what does it mean? Well, it means we are looking here today. It's the 5th of the 5th of June. That means we have to look at the 4th of June here. That is where we opened the trade. That was here at the closing price. So we opened the trade here. Closing price is 17.69. Okay, this is the last price here in this candle, and then we keep the position open without a stop loss. So it's a long trade here, and right now we see the market dropping, which is very counterproductive for our trade, in fact. So market currently is moving or running against us due to this news release, these non-farm payrolls. Keep them in mind. Probably that's probably first step to adapt a risk and money management plan. If you have this news release, for example, you should keep it in mind, and also it reminds you why it's so important to have a risk and money management plan and not just run the trade itself. Certainly, I mean, if there's a big disappointment in the release, well, then there's also the chance that you get to see such a push higher and it runs in your direction. But at the end of the day, we as traders, we are risk managers, and risk managers means nothing more in this context than we have to take care of our risk first, while the winning trades will take care of themselves, in fact. And that's something you need to keep in mind in this context then. And this is a development which perfectly illustrates why such a setup working in a basic version without a stop loss needs adaptations, even though it must be a smart adaptation. So just place it in the stop and then just say, okay, let's take it from there. It's probably not getting the job done, in fact. So now let's go back to our presentation here. So Let's first of all have a look at the backtest results. So this is very important. Before we start with adaptations from a risk and money management perspective, it's definitely noteworthy to look to check whether this setup is really profitable in the real world. And what did I do here? Well, very simple. I went to the website, it's investing.com, and there you can download market data for free. In our context, in fact, it is daily data, which is available for a quite long period of time. It's completely available for free. And it's also, since we are working only on one trade and we only need two prices, in fact, the closing price of Thursday and the closing price of Friday, it makes it easy, let's say, easy to backtest it. And I don't need to be scared that the data we are looking at here is, let's put it simply, it's not good data, okay? And needs a review first before we use it for backtest purposes. So in this context, it's in fact possible to go to an open source in this case and get the data from there, and everyone can do the same for himself. You just go to investing.com. By the way, let me just probably guide you through this. So you go to the website investing.com. Okay, so now the only problem we might probably have now is, this is something I want to avoid because it's not really professional, to be honest. What I'm talking about is it's a website which is usually available for free, but now you probably have a pop-up from every broker out there, and I just don't like it. To have now a broker pop up here from whatever broker in a webinar. For Admiral, to be honest, and it takes, unfortunately, a little. Let me just see. Okay, it takes too long. It takes way too long. So just let me skip this. It doesn't matter. It doesn't matter. Just check out the website, investing.com yourself. And there you find, under the tab commodities, I think, you can not just see gold prices, but you can also see silver prices. Click there, and then you can filter the data accordingly, look at daily data, in fact, and then get daily data back to, in this case here in our backtest result, back to January 2003, in fact. So nearly 20 years of data which is available there. And then you run the backtest. So what we do is, let's go back here to the setup itself. What we do is we buy every closing price on a Thursday here, and we sell the position every Friday then, before market closes, in fact. No stop losses set, no take profit is set. And if you run this backtest via Python, for example, if you manipulate the data accordingly, that you can work with this, you get that during this time span here, you have a number of trades of 871, a hit rate which is not that great, and in fact the payoff ratio is also not as nice as it has been for gold. The same setup for gold is way more profitable, in fact. And the equity curve, check out the video. So we have Let's Trade Gold, the webinar in our Trading Spotlight Series 2. You can see that the equity curve is way more smoother, let's say, than the equity curve here. But it's, as an idea, it's probably also noteworthy. If you don't plan to trade the setup itself, it's probably something which is interesting to keep in mind once you plan to trade silver, gold on a Friday, especially silver. So there's a seasonal tendency or seasonal bias, which means that silver trades higher on Fridays. And what you can see here is that's in more than 50% of cases, which is also true for gold, for example. So it's similar. In fact, gold has a hit rate of 60%, similar, or into the region of, I think it was 57, 58%, if I remember that right, when I run the backtest here. And it means that naturally on Fridays, usually silver, also gold, tend to trade higher. So it's not just an idea based on some assumptions we make that there's risk aversion coming into the market over weekend, because you want to avoid that there's some news hitting the wire, some bad news, some I don't know, attack taking place, some country invading another, something like that, and you can't intervene in the market because it's weekend. And that's why you try to hedge this risk by buying a precious metal like silver, like gold, which is naturally resulting in a higher demand. That's one example why this is taking place here. And it's not just an idea, it's not just a gut feeling, but you can see it here when looking at the hit rate itself. So you need to start, and they usually start right into the close on a Thursday and keep on buying, or the demand keeps on increasing naturally over then the Friday, the day before the weekend. And the payoff ratio, this is something which is annoying a little, but it dropped due to the developments, recent developments here, in fact. So you can see that there was some massive drop due to Corona, due to the fact that there was this liquidation taking place. And it also is, it's not the main driver, because the max drawdown was here generated during this time, in fact, but still it doesn't look very, very nice. Again, this is why it's so important to see where this adaptation from a risk-reward from a risk and money management perspective comes into play. When looking at the backtest result from gold for the same strategy, you will see that it looks really smooth, and you probably don't see so many, let's say, reasons to adapt or find adaptations when it comes to risk and money management, because the strategy obviously works. And so you're probably saying, well, I don't need to adapt anything here. I just traded without a stop loss. Such a perfect example here for silver. You can see it's profitable. It works, even though the performance is not as great as it has been for gold for the same time span. But what's great about this is that you can see such adaptations from a risk money management perspective are obviously necessary. And this is exactly what we want to do right here. And I want to show you something we've done already in the past. And I want to once again work with Monte Carlo simulator, one which you can find on my website for my book, which was published in German. So this is an English-speaking webinar. It doesn't make that much sense to make my book here a topic, but probably for some of you, it might be interesting to use this Monte Carlo simulator, even though it's in German. So it's a little difficult, let's say. And I will post the link to this Monte Carlo simulator also in the chat box of the YouTube, into the YouTube description box, let's say. Still, we want to use some screenshots here and from some simulations I ran via this simulator. By the way, it's for free, so it's no need to pay anything for that. I'll just check out the website and go there, and you can use it. So what we do here is we enter our hit rate in this calculator of 52.8% and our payoff ratio of 0.99 to 1, which is not that great, to be honest. Then we simulate 1,000 trades and generate 15 different equity curves with 1% risk per trade. And this is how it looks like then. So what we do is we enter these parameters here, and these are the equity curves we get. And they're not as nice, they're not looking as nice as the ones we created with gold, but still there's a positive tendency. And the big white line, by the way, this is the average line. So it averages all generated equity curves here we generated. And this is what we get in this Monte Carlo simulator. This is what we get, which is probably of interest for you. So there's first a parameter we call Kelly. It's a criterion which makes it possible from a purely mathematical standpoint to find out what's the optimal position size without any adaptations, by the way. We also had a webinar on Kelly in the past, if I remember right, also here in our Trading Spotlight webinar series. And Kelly 0.05 means that you should risk 5% per trade, given those input parameters, and given that you can stabilize these parameters here in the future then. You have here the average performance. The average performance is around 40%. But by the way, we work with 1% risk per trade. You can also change that once you say, and this is the next point, it reads größter maximaler drawdown. It's the biggest max DD, okay? The biggest max drawdown you see here within such a curve. In this simulation, it's 39% around, which is too much. So let's look at it from a pure, not just money management perspective, probably also from a professional trader perspective, from a money manager perspective, or wealth management perspective. Just imagine you go to your asset manager, hedge fund trader, whatever, hedge fund manager, and you say, hey, by the way, I have here something like 10 million. I want to invest with you. And so what's your max DD? And he's saying, yeah, 39%. Just imagine it. I mean, if you have a max DD of 39%, and you invest 10 million, that means nothing more that you're willing to lose at one point from peak to valley, 3.9 million. So in the initial reading. So probably we see 10 million running up to 20 million, but still 39% remains. Only that then we're talking about 20 million and 39% on that, which is then doubling the number to 7.8 million. You're willing to lose before the market then hopefully turns around and marks new equity highs. So 39% is too much. In my personal trading, in my aggressively traded account, it's not the investment account I call it, but the trading account, I'm trading more aggressively. I'm willing to take a max DD of 25%, and even that it's this is the last point. So this is like if I reach this point, then most of the time I quit the trading project already before, because the strategy is obviously not performing well. And I've also taken several steps to avoid the drawdown to grow larger, for example, like reducing position size and everything. So 39% is just too much. And it's mostly resulting out of the fact that you're only getting paid 99 cents per every dollar on average you lose. So this is just not very attractive. And then one reason to probably rethink the strategy. So not take it as granted, but just take it as a basic idea and build something on the strategy itself. And yeah, so what you get here is, so we can skip this. This is the min capital. This is like the minimum capital you had in your account, which means if you start with 10,000 euro, what we did here, you've seen here that it's 7,457, which means you lost slightly more than 2,500 euros, which means that the biggest DD here, obviously, was not capable of bringing you really down to something like 6,000 from your initial stake of 10,000, but still, it's quite much. Max winners. What's the English word for this? So it's like it's the winning trades you had in a row. Yeah, winning trades in a row. That's probably a fair way to put it. Same is true here for Max folgende Verlierer. This is Max losing trades in a row. In fact, this is also interesting from a trading, from a mental perspective. So you probably faced series of winning trades. In fact, and sometimes after 3, 4, 5 trades, you might probably say, okay, the strategy is not for me or it's not working because I'm losing 5 times in a row. From a purely mathematical standpoint, even if you have a hit rate of 52.8% here, losing 13 times in a row is normal from a purely statistical mathematical standpoint, in fact. Here, this is more interesting. It's the so-called Erwartungswert. It's the expected value, which reads 0.05, which means per every euro you risk, you can expect to gain 5 cents. Okay, so it's a positive number means the approach is profitable. At least here for this generated simulation, respectively the time span you look at here. And so the average max DD is 22.5%, so on and so forth. But what you can clearly see is the setup itself is profitable. Still, now the question remains, what can we do to adapt our risk and money management in this case? So one step, for example, could be that you say, I trade the basic version. I'm not trading with a stop loss still, and so that means that if the max DD of 39%, for example, is too high, and I want to reduce that number, I need to scale down when it comes to risk, taking the risk in the position, which means you could say, okay, no, then I'm risking only 0.5% per trade or 0.3%. It's like it's like a strategy you use in addition to other strategies you're trading. Or again, you can also say, okay, it's a basic strategy I'm trading here. So it's like, I don't want to trade it, but I will use it to, or I will use the seasonality that silver is performing well on a Friday. And that's something I use. So I'll tend to take a more aggressive approach in other trading strategies I'm running in silver on the long side every Friday due to this seasonality. While if there's a short signal generated, I'll scale down and I'm not traded as aggressively. Probably I skip the trade, and the overall target is to smoothen the equity curve and to make my already profitable approach even more profitable, thanks to knowing this seasonality, for example. So there's several ways how you could do this. Another way is, for example, that you could use an approach based on the ATR, for example. So which means you look at current volatility levels and then you place a so-called worst case stop, which means, let me just skip again here, or switch over to the to silver. So you can see here, there's the ATR. It's the 4-hour chart. Let me just probably go here to the daily chart, and then there we go. So this is not true anymore. It's now a daily chart. Just I want to adapt this now to avoid that there's some now irritation taking place. So what you can see here is that ATR is currently at 50 cents on a daily basis. That means for the last 14 days, the average width or the average length of a 1-day candle, of a D1 candle, has been 50 cents, which means that you're working then with a 50-cent stop. Okay, so that means, or 60-cent stop. That means you're saying I'm going long on the closing price of the Thursday, and then I look at the ATR. To avoid position my stop into the noise of the market, probably I extend this to 1.5, let's say, as a worst case stop, 1.5 ATR, which means in this case 75 cents, for example. But you use volatility and the current volatility levels to formulate your worst case stop, which will then save you in a case of let's say, flash crash probably happening. So markets really collapsing, and you see a significant hit from a P&L perspective due to not using a stop loss in your position, for example. That's also an approach. But, and this is something which is important, if you manipulate the strategy, which is initially in a basic version and the backtest you run working without a stop loss, if you do that, then there needs to be an adaptation from your end. You need to see, then you need to download data, which also includes ATR values, and then use the ATR value and see if you place your stop via the ATR, could this have prevented larger drawdowns, respectively? Is the strategy you trade still profitable? So this is something you need to take into account then too. So use data on ATR as a gauge of how much risk you're willing to take or where to place the worst case stop. And once you do this, you need also to run the backtest again and see whether the strategy stays profitable when using this approach, in fact. So yeah, that's in fact it on the how to profitably trade silver. So let's have a look here at the summary. First of all, first point is silver can be profitably traded with one trade per week, similar to gold. You go long on the closing price each Thursday and close the position one day later at the closing price on Friday. At least it was profitable from January 2003 till today. A problem of the strategy is, as shown, that it works without a stop loss. And that's why it's so important that silver is, first of all, a very, very liquid asset. But in addition to that, it's also necessary that you do adaptations from a risk and money management perspective, which can be done, for example, with the help of Monte Carlo simulations and further backtested data like the max trading range within the trade time frame. Emergency stop loss can be formulated and set based on ATR, everything like that. So that's it, in fact. So nothing more to add here. Don't forget to join us next time. Next webinar here will be on Monday, same time, together with Paul. And there he will guide you through his trading strategy on the FTSE, in fact. So if there are FTSE traders out there, then Paul welcomes you, and will not just define what is the FTSE, but also he will answer what does a trader need to know about the FTSE, and then how do we analyze the FTSE, and finally, how do we trade the FTSE 100 using the MT4 in this context then. And the webinar starts on Monday, as I already said, 2 p.m. London time, 8th of June. If you are now listening to that here live, then you don't need to do anything but just check your inbox for the webinar link, which will be sent to your inbox. If you watch this on YouTube, then feel free to check out admiralmarkets.com, and there the education's webinar tab, where you find, or education tab, and there's webinars, and there under webinars you find trading spotlights, probably a better way to put it. There you can register for the webinar. Then you will get the link to your inbox, and admiralmarkets.com. There you get further information, further analysis on the markets, everything around education. Feel free to check out the website. And if you have any questions, not just in regards to this webinar, feel free to ask the questions, not just under the YouTube webinar here, the YouTube, if you watch the recording on YouTube, write the check box plus the box where you can ask your questions. But in addition to that, feel free to check out our Trading Spotlight Traders Yard community, in fact, and every other question in regards to Admiral Markets, feel free to check out here the email, YouTube channel, respectively Facebook presence from Admiral Markets. This is the risk disclaimer, and that's it from my end. So all the best from Berlin, Germany. I wish you happy trading, watch your stops, and talk to you again next week on Friday. I look forward to it. See you, and bye-bye.